everyone. For those who just logged on, again, my name is Dominique and I am the Investor Relations Manager here at Greenleaf. I have the rest of the Greenleaf team here with us today. Today we will begin discussing our end of quarter review for the QOZ fund. And first and foremost, Greenleaf hosts weekly live streams and private connect events every Thursday afternoon with a new topic every week, highlighting a portion of our business. Private events being more interactive, while live streams are open to the public. Before we dive in, we want to provide you with a quick overview of what to expect this afternoon. First, we will provide some rules of engagement. We'll jump into some tax updates, fund and market segments. We'll discuss our current value, and then we'll close with our question and answer portion of this broadcast. To begin, I have on the screen some rules of engagement. First, you do have the option to change your presentation view. Feel free to switch your attendee presentation mode to speaker spotlight or click and drag to make the presentation and our panelists bigger or smaller. There will be a Q&A portion at the end of the presentation, but you do not need to wait until the end to submit your questions. You can click the Q&A button located at the bottom of your screen to submit any questions you may have, and our team will be sure to answer those. This is a friendly reminder that this live stream is recorded and we will be sharing this via email by the end of the week. All right, without further ado, I will pass it over to Dave Codray to begin our discussion on the QOZ fund. Thanks, everyone.
All right, thank you, Dominique. Welcome to our end of quarter update on the QOZ fund here, folks. Just a recap on where we're at with the fund as a whole. So we started this back in January of 2019. We put $12.3 million of capital gains equity into 6 projects. So we did Fairway, which was a 64-unit apartment deal, the Grove, 94-unit townhome deal, Heritage Square, which is a 40-unit apartment deal, and it's actually right next to Fairway. So those two are very close. And then once we did those apartment deals, we kind of moved into the commercial space. We did the Station, which is here in Norcross, Georgia. It's about 110,000 square feet. The Lupton up in Chattanooga, which is 55,000 square feet, and North Graham in Charlotte, that's about 25,000 square feet. So overall, it's 198 residential units and 191,000 square feet of commercial. So it's a pretty good mix, and we've purchased these between January of 2019 and into 2020. So if we look at the last update we did, we spoke a little bit about taxes, and taxes have been certainly a discussion point throughout all of 2021. When we look at things from last quarter, specifically with opportunity zones, in that video, I mentioned a lot of them that there were new opportunity zones and opportunity zones that went away. You know, we were lucky that it didn't impact any of our existing either zones or assets. But we were optimistic that we'd been able to find something in those new opportunity zones that came out. Something, you know, we're out and looking around in multiple asset classes. We have not found anything yet. And even if we did find something, it wouldn't go into this fund. We would start a new either single asset or work on that as it came out, but obviously bring it out to any of our QOZ investors that we currently have. There are also extension periods for your qualification times. So even if it's not with us or if it's with another opportunity zone group that you're working with, those extensions were pushed out to the end of this year. So there's more time to do the QOZ investments and defer those gains. Originally, it was a shorter time frame. So those are the 2 main changes to recap from last quarter. Going into this quarter, as we think about the tax changes that the current administration is working on pushing through, obviously there's been a lot of stimulus that's going out, and to pay for that, they're going to raise taxes. That's generally how it works. So right now there is this thought that over $1 million of ordinary income or over $1 million of income, that your capital gains are then also going to be treated as ordinary income. That would obviously increase a lot of the capital gains rates from 20% up to whatever the current ordinary income rate is. So that's obviously a concern. You see like rising taxes, and this is kind of a whole tax deference plan is what we're doing with the Opportunity Zone Fund. But something to keep in mind is that we are preparing for taxes in 2026. So that's the first time frame that taxes are going to be due from the deferred gains back from 2019. So our strategy, as we're looking at this, is by 2025, we are going to make a distribution out of the QOZ fund to help pay taxes that are due in the 2026 year. And those taxes in 2026 will be based on whatever the prevailing rate is at that time. So not only this administration, but whatever the next administration is, there's a good runway of time that we've got to get through to see what those rates are actually going to be. The other thing to think about is when we invested capital gains, we did it with no basis. So the gains that were invested into this, essentially, like, they didn't really exist yet. So to distribute money, like we're talking about here in 2025, we have to earn that money, and we can't do it on equity. It's got to be through retained earnings and gains from cash flow. That will give us our basis that we can then distribute. So if we look at the biggest part of the QOZ was kind of this construction phase. You know, we bought all value add deals, and it was go in, renovate them, spend a good chunk of money, and get them to a stability point. So if we look at where we're at today, we've completed the Fairway, Grove, Heritage, the station. All of these projects are completed on a capital front. And we just wrapped up our North Graham project that's in Charlotte. And the last one we have is the Lupton. The Lupton, we're waiting on our windows there to be installed. That's the biggest thing we have left. The other part too is within the station, Lupton and North Graham, since these are commercial assets, we have our tenant improvement packages that we'll be doing from a build out standpoint. So we still have leasing to do at all three of these assets, but we'll be continuing with some tenant improvement. The core of the capital spend and the capital improvement has been completed everywhere except for the Lupton, as I mentioned there. So what does that kind of mean going forwards? Again, we started 2019. We've got to hold these deals until 2029. As we wrap up this slide is typically like the most exciting part of like what capital improvements are we making and where we're going. As that kind of phases down, we're going to start looking more towards just operational metrics and charting on how are we doing with revenue, how are we doing with expense ratios, what does this asset look like as we add value operationally now over the next really 8 years as we hold these assets. So that kind of just changes how we do our reporting. So if we look at the fund as a whole, and we'll jump into our revenues here. So the second quarter was great from a revenue standpoint. And you can see our fund has continued to add incrementally additional revenue every quarter, all the way since Q1 of 2020. This quarter was one of our biggest revenue gains that we've had. We were able to hit $476,000 on residential, and we're up a little bit on commercial at $207,000. So overall, we broke $600,000 in revenue for the first time in the fund, which is super exciting. Diving into just the residential piece now, you see our revenues really climbing here in the second quarter. Our Fairway property revenues were up 5%, Heritage was up 150%, and the Grove was up 34% in revenue. So put all that together, obviously there's different unit mixes there and different numbered units at each property, but revenues are up 23%. From a break-even standpoint, on the residential side, we're always trying to get to how much do we need to make so we have positive cash flow. And here we hit that this quarter. Our break-even point was just under $400,000, and we really blew through that in Q2, which is exciting. Now, it wasn't that our break-even point was the same number going back in time. Deals like Heritage, prior to Q1 of this year, they were vacant and under construction. So their break-even point, we didn't really have a lot of expenses. So this is our break-even point with having occupied assets. So we are very excited that we're at this point now on the residential side, and we see this kind of just growing as we look at holding these assets for the long term. From an occupancy standpoint, a lot of our revenue driven not only from occupancy gains, but rental rate gains, but we did have some pretty big occupancy gains just in the second quarter. We're at 98% overall as a fund. So I don't think we're going to be getting too much higher than 98% occupied. The remainder of the growth that we project and that we want to see for Q3 and Q4 is going to be around our rental rate gains. Occupancy-wise, Fairway is steady at 90%. Heritage is 97% occupied, up from 72% last quarter. If you remember last quarter at Heritage, we did a lot of leasing. We went from 0% occupancy really at the end of Q4 2020 up to 72%. But during that people weren't paying rent that whole period. It wasn't like, hey, one day, January 1st, and we're now 72% occupied. So as leases came in, really Q2 is the first full quarter that they were paying rent for the whole time frame. And then the Grove was at 99%, up from 86%. That property, just like we did with the other ones, it was a big dip down to 20% occupancy, and now all the way back up. So we're ahead of what our schedule was for the year. We were ahead last quarter. We're still ahead this quarter. And going forwards, we kind of hold a steady 95% as our projection. Anything we have above that, if our occupancy is higher, that means there's room to work on our rates a little bit, push those some. But ultimately, we want to maintain our retention, keep our occupancy high. So residential has been a success. We all know the apartment market is doing very well, but also we purchased our residential assets first. So we did these 3 deals first, and then we moved into the commercial segment of our acquisitions. So here on the commercial side, we see revenues that, although they're inching up a little bit, this is really only on one asset, and that's the station. So up from Q4 of 195, we did 206 last quarter, 207,000 in revenue this quarter. Really where that came from was we signed 11 new leases in Q2 in our executive suites, and we signed 3 main leases. That took us, we added about 5,000 square feet in occupancy just at the station alone. Now our rental rates on those hitting this revenue numbers, when we first did the station, we were projecting around $13 to $14 a square foot for our classic space and $16 to $18 a square foot for our renovated space. We've been wrong before. I'm sure we'll be wrong again in the future at some point too. But what's happened here is our classic space, the leases we signed were at $16.50 a square foot. So our classic space is really where we're seeing a lot of demand. And the renovated space we did, we're not seeing as much demand. We really haven't leased anything in the renovated space. Those are more open floor plans, higher ceilings, lots of natural light. Whereas a classic office is one, it's also where we're sitting right now, but you see drop ceilings and more individual office layouts. The tenants we have are all in this mindset of move in and let's get to work right now, not move in and let's do a big TI improvement project for space and get it custom how we want it. But we do not envision taking the space we have and converting it back to a more classic layout. We're going to keep that renovated space, and we'll probably lower the rates here as we go forwards and look at leasing to drive occupancy there. So overall occupancy in the commercial space, we're at this 35%. We added a little bit, mainly just because of the station. And we see our jumps really happening in Q3 and Q4 as we sign leases at North Graham and the Lupton. Now I mentioned like these projects, they started a year after our residential. So residential is definitely ahead of the curve on occupancy and revenue, but we're expecting to see occupancy jumps here in Q3 and Q4 with the commercial revenue coming in Q1 and Q2 out in, what is that now? That's 2022. Because most of those have leasing concessions up front, so they get a couple of free months with TI allowances that are burning off and revenue comes shortly thereafter. All right, so now we want to dive into the value proposition of the QOZ fund and as a whole. And again, if you have any questions kind of on that residential side or on that commercial side, and they're top of mind, you can put them in the Q&A section here within Zoom, and we'll touch base on all of these as we get to the end of the presentation. Now, value proposition wise, our whole plan with QOZ was to buy these in that 2019 timeframe, add value through physical improvements, and then follow up with operational improvements. That's really the game plan of Greenleaf as a whole. We've looked to do that in all the market segments that we've ever invested in. And then we know by 2025, we have to realize some of this value through cash flow gains so that we can distribute that, pay our 2026 tax liabilities, and then ultimately 2029, we've positioned these assets to be strong performers, and we can exit and pay no capital gains. That is the real value proposition of this fund. We've had some other questions like, hey, what if we don't want to exit? It's like, well, 2029 is a long ways away. We can look at that, but also the QOZ kind of dead ends at 2046. 2046, it all goes away, and you have to sell the assets by then. I know that's super far in the future, but it's an interesting time point. So if we look at our total value that we're at right now in the fund, sometimes our videos where you're walking around, you're getting to see the construction might be a little more visually appealing, but this is more of a table of numbers. And at the end, it shows us kind of where we're at value-wise, which that part is exciting. So the first three deals, the residential side, we have Fairway, Heritage, and The Grove. And we look at the values on these deals of what's in the market right now, and we see values in that $100,000 to $110,000 a door range. You can see our purchase at Fairway. If we look at Fairway in that vertical strip going down, we purchased it for around $3 million. We spent about $1.35 million on improvements, making sure that we improve the building value, again, not the land value, but the building value to meet the QOZ threshold. And our current basis is just over $5 million. So we look at that purchase, renovation, and current basis, that doesn't add up, right? So there's some negative cash flow that happens during that renovation process, and that's added into our basis as well. And then we look at our estimated total project value of $6.4 million on that deal, which is $100,000 a door. Fairway is 64 units. From there, we mentioned this when we went into some of these QOZ deals. We want to kind of bring this back up and touch base on it. We purchased the first 4 deals with a mix of QOZ equity and fresh equity. And it's like, well, how does that work? We in the structure, the deal will follow the QOZ guidelines, but there was fresh equity that still wanted to be along with our general Greenleaf business strategy of buy, renovate, operation, improve, and hold an asset. So we had fresh equity that wanted to be along with that. It's not commingled with the QOZ fund. The QOZ fund in Fairway owns 59% of the deal. So that fund value from Fairway is roughly more exactly $761,100. That's tied to the equity of Fairway. And if we follow that thought process along the bottom there, you see 1.2 million, 1.1 million, 1.5 million at the station, with which are the equity positions from the QOZ fund. The last 2 deals, the Lupton and North Graham, being not occupied, there's not a whole lot of value there, more just like what we're seeing in the market and what we've paid for them. But as we sign leases there, that's where we're really going to see our value improve on those assets, and depending on that lease, tying it to the market to get our market value. Now, if we add all those up for the fund as a whole, right now that $12.3 million we invested, we're seeing about a 45% increase in our value. The fund, remember, 12.3 million, we have a 10% preferred return on this deal out through 2029, which essentially means we're doubling equity before there's a profit split. And we feel like, 100%, we are 45% of the way there. We've created a good amount of value now. We see additional value being created on these commercial leases as those are completed and signed, and then operational improvements as we go forwards. So really our goals from this point forwards are working on the operations, really getting these things humming and producing cash flow, and not just increasing our value. Okay, so that's where we stand with the QOZ fund. I'm going to turn things over to Natalie, who's sitting right to my left side here, and we're going to go through any questions we have on the fund. Hopefully, get anything answered there that we can for you.
Thank you, Dave, and thank you everyone who submitted questions. We'll dive right in here. First up, we have a tax question for you, Dave. Can the government change the QOZ tax rules or benefits midstream? The current administration seems less favorable to the tax incentives provided to encourage investment.
I'm not going to say the government can't change something, but they can certainly, create challenges. It's probably easier for them to change the tax rates than change the tax policy of how we do a QOZ. So one of the big parts of the QOZ was this 15% basis write-down that happens in 2026. That didn't get changed with the administration's budget. nor did anything get removed from the QOZ policy as a whole. So none of those things were changed. And I think the administration, currently the Biden administration, their tax policy and budget, was a very aggressive that came out, and these didn't change. So I don't, personally don't believe that they're going to change those tax rules, but they obviously could. I think it's easier to change the tax rates, which is what they've done with changing capital gains to ordinary income. We're seeing that part of it.
Okay. And this is a two-part question. For the Lupton and North Graham, is the pro forma based on classic or built out space? And if it is built out, seeing there is no real demand for built out at the station, how will that impact the lease up and general performance at Lupton and North Graham?
Yeah, so the pro forma on Lupton and North Graham was on built out space, but there's not, when someone looks at the station, they have two options to pick from, and they're picking the one that's easier to get into. Obviously, when we look at Lupton and North Graham, we've got to compare it to what's available in the market. There has not been a whole lot of delivery in those marketplaces within where we're at. We obviously have much larger TI packages that we're willing to offer those tenants as well to do the space, and that was in our pro forma, or in our expectations. So yes, it's like we've got a challenging mix of stuff on the commercial space, but we also have a really nice product with good TI packages. We've already had some leasing inquiries and some LOI discussions that are based around us building out the space for people being there. So there's definitely demand for it that we're seeing. It's just longer than, hey, I want to move in next week, and well, here's a ready office, so I'll take that one.
Okay. How are we doing on cash? Do we have enough to last through the longer than expected time to lease the built out space?
So on the commercial, our hold costs for deals like the Lupton or North Graham they're pretty minimal. So from a cash flow standpoint, that really helps. On the residential side, we're past our break-even point now, so we're adding cash on that side. So we feel like we're in a good position. I don't have the total dollars of cash that we actually have and what our future, positive and net looks like, but we're positive overall across our residential, and then the station are positive. It's just Lupton and North Graham, they're not positive, but their carry costs are so low that it's not hitting us on cash really right now.
Okay. You touched on this a little bit, but will we add any more deals to this existing QOZ fund?
Yeah, not to this fund. We had some thoughts about that in the very beginning, but with that 15% basis reduction, that window has passed. So new QOZ funds will not get that depreciation reduction going into 2026. So we would not buy a new deal and put it into this fund. We'd open up another either individual fund, or if we had multiple properties, we'd do another fund in this kind of a structure.
Okay, that's a great lead into our next question. What would it take to start a new QOZ fund, and could it be done with just a single deal?
I can definitely be done with with an individual deal. There's no issue in doing that. With starting a fund, we'd really have to see a path to finding multiple deals that fell in these opportunity zones. Now that the opportunity zones are really, they're baked in there and everyone knows that they're there, it's really driven values in those areas. It's driven them up. Sellers are basically saying, well, you don't have to pay tax on this, so you should pay me more, which doesn't always work that way from a buyer standpoint.
Okay, our last question, which is a good one to leave you with. What's the future of the fund, or what's next?
Well, we're shifting basically to an operational status within the fund. So our next goal is this 2026 horizon, making sure we can build as much positive cash flow as we can and distribute for the tax liability that we're all going to owe in 2026, and then holding through 2029. That's our goals right now. So yeah, that's where we're at.
Well, I tricked you. I got one more question that just came through, which is a good one. If not adding additional new deals to the fund, what will happen to the free cash flow if you can't distribute it back?
So as we earn free cash flow and we create a basis, we can distribute that basis. So free cash flow, if we have a basis, will be distributed if there's not something to invest in. And quite frankly, there won't be other deals that move into this fund to invest. So as we create basis through cash flow, we can distribute that money. Our horizon was to do that by 2025. And if you look at our residential ones, right, like those are positive, but they've got to make up for all the negative that they had before they create a basis that we can distribute. So I hope that makes sense. It's like imagine if we had a negative $100,000 of retained earnings from negative cash flow, we've got to earn that $100,000 back and earn more, creating a positive basis from cash flow, giving us the ability to distribute.
Makes sense. Okay, well, again, we thank everyone for submitting your questions today. And of course, we want to thank our host, Dave, for sharing these QOZ fund updates with us. As we wrap this up, just a friendly reminder of some of our upcoming dates. Dominique's going to put this back on the screen for us. First up, we have our end of quarter reports that will be made available by the first week of August. And then we have our upcoming live stream schedule here on the right for you. Today at 2 p.m., we have our Oak Hollow property update. On July 22nd, we have a new deal overview for Dollar General Statesville. Then leading into August, on the 5th, we have our end of quarter reviews for both residential and commercial, which will be 2 separate live streams. On the 19th, we have our Park Hill refinance update, our second one. And then August 26th, we have our Greenleaf investment strategy overview for you. Don't forget to check out our Greenleaf Connect YouTube channel for all of our recorded live streams, with this recording being made available over the next 24 hours. And this concludes our QOZ Fund broadcast. We certainly appreciate you joining us today, and we look forward to having you join us on our upcoming live streams. Thanks again, and enjoy your day.
All right, thanks everyone. Have a good rest of the afternoon. Dropping everyone off now. Moving on to